Welcome, everybody. We're going to wait a couple minutes past the hour here to go live, give everybody a chance to join. So please hang tight. We'll start at 3 after. And as we get queued up here, everybody will see the public chat over to the right. We're going to save some time on the back end of this to do a little Q&A. So please go ahead and drop any questions in there. Yeah, feel free to give a shout out where you're from. I see some Chicago and Dallas and Scottsdale tuning in. Louisiana, right on. And we'll start in just another minute here. Greg, thank you. You're hearing an echo there? Turn off my volume on the second device. Buck in the gang, can you guys hear me okay? Any echo? Great. Fantastic. All right, let's go ahead and get started here. Want to give a warm welcome to everybody tuning in from all across the globe here, as I can see in the chat. My name's John Stid, and I'm the Chief Growth Officer here at Dealmaker. I'm excited to be moderating today's panel session on raising capital in robotics. How do you scale your vision on your terms? So if you're here, you probably already know it's hard to raise capital when you're building something ambitious, especially if it involves hardware and robotics. Fortunately, these panelists didn't follow that standard playbook, and they're here to talk about it. They didn't wait around for institutional funding. They built powerful brands, raised millions from retail investors, and scaled companies on their terms. So today you're going to hear what that actually looks like and how to do it. Before we jump in fully, a quick disclaimer. This is not legal advice or business advice. We do not recommend any issuer. You should not act upon any information from this presentation without seeking professional advice from your trusted advisors. These opinions represent the opinions of our speakers only and not any entity in the Dealmaker group. So with that, let's get underway. I want to start with a quick round of intros so everyone in the audience can put faces to names here, understand the perspectives you're each bringing to the table. I'll call on each of you for a quick intro round here. Just let us know who you are, what your company does, and maybe one thing you're excited to talk about today. So Buck, let's start with you, then we'll do Rich and Hitton.
My name is Buck Jordan from Vibu. We build robots for restaurants, primarily around point solutions. We're best known for the avocado, which cuts, cores, and peels avocados for Chipotle. So we got a lot of guac around here. We really understand restaurants, what the labor in the back of restaurants, better than most brands, because a lot of brands, and most companies, but a lot of brands invite us into their back of house to study every minute of labor. The output of that is that we get to identify places where we can inject automation to create ROI for these brands. And so primarily we've been focused on point solutions. So the best known one that we're doing is the avocado. We're also working on some more generalized robotic solutions, trying to bring humanoids into the back of house of kitchens, but also the supply chain of restaurant supply chains like agriculture. So happy to be here. Been working with Dealmaker since the beginning, I think. And so thank you very much.
And then I'll jump in, I guess. I think I'm next. So I'm Rich Hall. I'm the CEO of Miso Robotics. Buck, of course, left out one very important part of his resume. He was a founder of Miso and is a friend of Miso, a shareholder of Miso, supporter of Miso, and so forth. And so we too operate in the restaurant technology space. We are working on modernizing the kitchen in restaurants, similar to what some of the things that Buck has going on. And our signature product is named Flippy Fry Station. He has become a very famous robot. He cooks everything you would ever want to cook at the fry station. He's operating in live kitchens around the country and quick serve restaurants, Jack in the Box, White Castle, and some others. And he's really, the leader in the space. And Miso was a first mover in kitchen automation and has been around for about 10 years. And Flippy has just moved into his third generation, which is generally the third generation is the generation of any new product that scales. And so we're now seeing that scaling. And that's what I was brought in to do. I'm fairly new to Miso. I was brought in by Buck, the board, and one of our large investors, Ecolab. And Ecolab, for those who don't know, is a $70 billion public company that sells cleaning solutions to probably every restaurant you've ever been in. So I had just had a big exit on my last company and was leaving the acquirer and got a call from Buck and Ecolab, and here I am. So I am not an engineer by training. I've learned a lot over the last couple of years. I love being on the leading edge of AI, but I know how to grow companies and create exits.
Thank you, Rich.
I guess I'll go next. My name is Hiten Sunpal. I'm the CEO of Rise Robotics. Rise Robotics is electrifying heavy machinery. Well, what we're doing is we have this core technology called Beltronics. We've taken hydraulic cylinders, taken the liquid out of them, replaced them with belts and pulleys, and ended up with something that's 3 times as fast, 3 times as efficient, and has built-in health monitoring, position sensing, and all the things that you need to make an autonomous solution. So very excited about that. This is my third role, either as a CEO or president of a company. Like Rich, I'm not the founder. I'm new to the company and have been here for a year. And what I'm trying to do is to take this company from being primarily an engineering company, doing research, now to a product company. So it's a very exciting time at Rise Robotics, this transition where we're going from prototypes to production units. The Beltronic technology that I was talking about, the cylinders, you can see the red cylinder in the background, that big cylinder that's there. That thing can lift 50,000 pounds, so 22 tons. So we've got some really big and heavy equipment. And then one thing I share in common with Rich is that Buck and I also go a way back, and Buck's tried to hire me a couple of times into one of his portfolio companies. It hasn't worked out yet, but maybe soon.
I'll still try. One of the best.
That's why we brought you all on today. Well, thank you guys. That's certainly a wealth of experience, right? That we want to share with the audience today. You all have some insights into how you've built companies, right? A lot of this is about rethinking the capital stack. Robotics companies, they don't scale like SaaS. It's capital intensive. It can be slow to generate revenue and potentially hard to explain to investors, right? So because of that, traditional funding routes like VC and institutional capital can be challenging. Some founders would have given up. All 3 of you are here because you've carved a different path and built, a funding strategy around your vision. So I want to dive into that a little bit. And Rich, we'll start with you. As you mentioned with Flippy there, your star product, Miso sits at this intersection of hardware, AI, and food automation. So that can be a lot for any given investor. How do you think about making that story accessible, investable to a general audience, right? How does the everyday investor sort of interpret that story that you're trying to tell?
Yeah, we do sit at that intersection, as you mentioned, between hardware and software, and specifically AI software. And I like that. Honestly, if you look at the success stories in that space, obviously some of those have gone on to just become household names, Waymo, SpaceX, Apple. And for investors, I think that collision of those 2 worlds creates differentiated returns, which is very attractive to a lot of investors. I'd say, kind of my perspective on tapping into retail capital for a company like ours was actually formed long before I got here. So my last company, which I was also a founder of, it's the VIX streaming service, which is today the largest Spanish language streaming service in the world, did about $1 billion of revenue last year, and we sold that about 4 years ago. And the original name of that streaming service was called Póngalo, which in Spanish means like put it in the tape and play it. And, Buck was on my cap table. He learned a lot very early on about crowdfunding and called one day and said, if you don't do this, you're crazy. And the more I looked into it, the more it made sense for me, because especially with a consumer facing business like what we had at VIX, it was for me kind of a similar strategy to the way people raise money for bars and restaurants. You generally don't take $100 from one guy, you take $1 from 100 guys. And that way you get this army of marketers that goes out there and runs around and tells their friends about this restaurant you own, right? And I can always get in and I can always get a table. And like, that's your word of mouth marketing army. And I think when I came to Miso, while they had already started their crowdfunding journey, and Miso's raised more than $100 million, it's one of the most successful equity crowdfunding stories out there, maybe the most successful, I'm not even sure. I think we've taken a similar approach, and we kind of view that army of marketers, and Miso's got 40,000 retail investors, as part of our secret sauce. We use that to go and evangelize the brand. And I think consequently, Miso probably has the most valuable brand in all of restaurant technology, maybe all of food technology, because it's so well known. So much capital has been used to just go out and market the brand, but then the investors themselves go and extend that brand. And I think that's a really valuable asset. Last summer, I was with my kids in a small town in Montana that doesn't even have a stoplight. And I was sitting at a playground talking to some local dad and told him about Miso and Flippy. And he goes, oh, I know Flippy. And that's a very common experience. In fact, that's the majority of the experiences I have. And all of that is simply because of the brand equity that was built through the investor base that we got through retail crowdfunding.
Wonderful. Yeah, I mean, that's the beauty of brand, right? And something like Flippy that's very visual and visceral, right? And then leveraging digital to get that word out there. That's that Montana story is great. Then for you, right? So
Mind if I jump in real quick before?
Oh, please. Yeah, sorry, Bucket.
I mean, sorry to interrupt, cutting you off, but like,
no, that's good.
I think that Miso, and especially Miso, while Rich has been operating it, has built one of the best brands in crowdfunding. And I think that anybody who's looking to figure out, how you can be successful at crowdfunding, you really got to study what Miso's doing. You should go to the webpage, go try to find the email copy that they're sending out. Like, a lot of thought and work goes into it, because this is not push button get money. Like that, you got to really work this crowdfund, and nobody works harder than Miso, and they've really figured out how to make that scalable and how to make that work. So if you're listening to this and you want to figure it out, you got to go look at Miso.
I think that's fair. I mean, I'll add one more thing to that, which is like, there was probably a time in equity crowdfunding where you just hung a shingle and money came, but those days are long gone, right? And the novelty of it, all that means is that the novelty of it is worn off, and now people are making very thoughtful investment decisions about it, and they're looking for a return on their capital, as opposed to just thinking, oh, this seems neat, I should try it. And so I think that's the evolution of the retail crowdfunding market. But if you ever needed a proof point for that, look at what's happening in the really large hedge fund space, where you've got BlackRock and really big firms, household name firms, that are now raising retail capital for their hedge funds, which they're calling evergreen funds. And they're tapping into that because they too see the value in it. And really the idea is simply that you're giving Main Street investors access to the deals that are going to become household names, which were generally reserved for a very small group of high net worth people who are very well connected, who could get access to private deals before they launched to the public, and they were making generational wealth. And so crowdfunding came in and said, well, we can do that same thing just on a smaller scale with everyday investors. And so now you're seeing some of the smartest institutional fundraisers on the planet now starting to tap into it. I think it's a great proof point for the industry. And I appreciate what Buck said. I mean, we do spend a lot of time, we kind of have this always on crowdfunding strategy where we sort of ebb and flow in terms of having rounds that are open, but we're always kind of thinking about our next round, and we're very thoughtful, I think is a good phrase, about how we go and tell our story and talk to our community and keep them updated. And communication is very important to us. So we're always thinking about what's the right way to talk about what we're doing to our community.
Well, Rich, I think that's a good point. I want to circle back to the retail investor there. That item, because as Buck mentioned, right, and then Rich, you said, there's probably a time several years ago where you could, throw up a website and raise some capital, right? But it's changed now where, you have to have, investors are investing in your brand when they do, right? So, taking the time to polish that brand and being thoughtful about email communications, this is not something to go to market with when you're still, back of the napkin sketch. It's important to build a brand around that. So I wanted to focus on that and highlight that point because, that's a good tip for anybody in the crowd listening. It's like, you need to, take note of companies that have done it successfully because their brand looks and feels good, right? It looks polished because, the benefit of raising capital digitally is that you can, do that from anyone, right? Somebody in Montana recognizes your brand, right? But at the same time, you need to have something that is polished and, looks like something that, somebody would want to invest in. So it's a great point about BlackRock, right? Like Larry Fink's, I think his last investor memo, talked a lot about that retail investor. So it's then for you, I know, in your past experience, it's likely that you've raised capital, you've done it with the institutional game. What made you decide that retail capital was the right route for you at Rise?
So a couple of things. So the first couple of data points was, is this possible, right? So having seen what was happening at MISO and then what Buck was making happen at Gray's Robotics, convinced me that there was an opportunity for Rise to do something similar. That was kind of the first piece of, okay, this is possible. And then the second piece was, okay, can we do it? And when I joined, the gentleman that brought me on board was Aaron Acosta. He's the former CEO, now the head of business development, one of the co-founders of the company. And right after he brought me on board, he said, we have a huge following at Rise. And even our suppliers who show up, these are, imagine a delivery that happens, right? Someone shows up with heavy equipment because we have a bunch of heavy equipment here. They see what we're doing. They start asking questions. And once they realize that we're doing something very new, something that's going to replace hydraulics, and they've dealt with hydraulic equipment and they understand the potential, their next question is, oh, how do I get in on this, right? And so we've had all of these people, either who know of us from the robotics community here in Massachusetts, suppliers that we work with, potential customers, and engineers that work at our suppliers' sites or our potential customer sites that see what we're doing and get excited, want to find a way to invest in the company. So he shared this with me, and I said, you know what? Maybe there'll be a time when we'll get a chance to bring these people on board. And then as we started talking to VCs, John, everything that you explained happened, which is that I started to get a sense of, okay, these guys don't really understand what we're doing. They're looking for SaaS, they're looking for AI, which, by the way, that bubble is going to burst soon because AI companies are getting eaten up by other AI companies in weeks, right? Even before they can acquire their first customer, they're out of business because someone came up with a cheaper, faster way to do something. So we built this business that has, 25 patents. It's got a nice moat. It's something that's going to be here for a long time. So we thought, okay, institutional VCs aren't getting it or need to see more proof points. They always want more proof points. How about we open up our last round and make that accessible to the public so the valuation is fair, it's what the institutionals have paid before, and let's do a testing the waters campaign to see what it looks like. So we did a test, and the test was successful. We had $800,000 worth of interest in a few weeks. And then that's when we said, okay, this is real. There are people with whom this campaign is resonating, and let's go make it happen.
Yeah, spot on. And I want to touch more on some of those tactics, but yeah, it's AI is a scary world right now. If you're creating some wrapper, right, you're you're next on Google's feature list, and I wouldn't want to be on their path. So, having seen hundreds of companies raise capital this way, I'm always, partial to the robotics companies. I love what you guys are building. It's visual and visceral, and you can see it out there, right? And there's some real moats around that. And I also think there's some competitive differentiators that you guys have built up in raising capital, and I want to talk about some of those tactics that Hinton, you were just speaking about, right? And Rich and Buck, we were talking about it in the Miso brand there. But when you guys think about investor acquisition and bringing on investors, whether it's storytelling, right, or channel acquisition, partnerships, or even something like email and the webinars you guys run, right? Can you touch on any specific individual tactics that you think move the needle in helping you tell the story of the company? Because I want to make sure that the crowd here hears that today. What are some of those individual tactics? And let's do reverse around the horn there. Hinton, we'll start with you on that one.
And before we move on to that, I just want to weigh in on one thing that you guys were just talking about to kind of punctuate both AI and institutional capital, because I agree that the AI market changes before our eyes every single day. It's, on the one hand, it's probably the most impactful professional, or most impactful evolution in our professional lifetimes that's going to happen, right? It's probably a 10x force multiplier for what we do and how we do it in every area of all of our lives. But one of the challenges is that most investors, even institutional investors, are priced out of it. Like, if you want to get into the next round of Waymo or OpenAI, you can write $1 billion check and they'll probably let you in at some insane valuation. But short of that, they don't really want you in that round. Good luck getting in. And so I think this is the opportunity. What you're seeing through companies like ours, and I say that collectively for everybody on this call, is the opportunity to tap into industry-specific AI at modest pricing when it comes to check sizes. And we're at the sort of cusp of the next wave of AI. The first wave of AI was generalist, like OpenAI is all things to all people. Whereas what you're seeing now is industry-specific AI, where companies like ours take those open source tools and really use it to go deep in a specific industry, in our case, restaurant kitchens. And I think it's an incredible moment for investors to be able to tap into that. And then also, as you were talking about around institutional capital, if you look at Miso, like if you need a proof point for retail investing, Miso has kind of three constituents on its cap table. We've got crowdfunding investors, and then we've got strategic investors like Ecolab, who's in very sophisticated, $70 billion public company. And then we've got some institutional investors as well. And so I think when you look at those together, Buck's fund, is one of those institutional investors from the early days of Miso. And so being able to have a home for each one of those constituents is really unique. And there's value in the retail investing side, there's value in the strategic investing side, and there's value in the institutional side. And having all of those play together on our cap table, I think, is one of the things that makes Miso, really unique. And so I don't want to hijack this call to talk about how we do it. And if you want to learn more, you can go to misorobotics.com and click around, and you'll kind of see what I'm talking about. But I think that that's a really great additional proof point here. So I'll be quiet and let you guys chime in on the tricks of the trade for marketing, and I'll surely jump back in after that and tell you how we do it too.
No, I love when this is more riff-based, because I was going to bring that up. Common misconception in equity crowdfunding is, it's like one or the other. And, we like to think about the capital stack, institutional funding, retail capital, that sort of thing. Buck, did you want to piggyback on that point? I'm really glad it got brought up.
Yeah, I think that like both is an incredible thing to pursue. You can't just do it overnight, though. You've got to build a brand. You've got to do all the work that you need to get ready for a raise. It takes a while. And so, I'd encourage people to, even if they're pursuing an institutional strategy, to also just kind of like run a crowdfund in parallel, and they can decide if they want to do the crowdfund or not. But there's some really interesting kind of features of a crowdfund. Versus an institutional raise. Institutional raise, like, you can just strike out and raise no money, and then you're dead. A crowdfund, you can hit big or you can hit small. You rarely hit zero. That makes sense. So I would recommend, trying to do both, because I do think there's a certain level of support that comes from crowdfunding that doesn't always come from institutional, financing, because institutional financing is all personality driven and luck driven, and do you catch the person on the right day, versus versus crowdfunding is a little more programmatic. And when it comes to like programmatic fundraising like this, I've raised from just about every platform out there, and now I'll only raise on Dealmaker, and it's because well, they've been in it for longer. John and his team at Reach specifically have been in it longer, have seen the tricks of the trade, so to speak, and they've got these lookalike campaigns that perform really well. And so I'd be really wary of going with, especially if it's your first time crowdfunding, I'd be really wary of going with someone new, or some marketing agency that you just met that you haven't properly vetted, that hasn't raised $100 million from Mesa Robotics or someone else. So I've found that, like, I guess dual tracking would be how I'd sum it up. It's good to dual track. It's good to make sure you're working with the best experts you can find, which for me has been Dealmaker. And then you got to be really thoughtful about how you tell a story, and also how you tell a story that works for both institutions and for crowdfunding.
Yeah, Buck, thanks for bringing that up, because dual track, right? But you talk about digital on it being more programmatic, right? The inputs and outputs are correlated. You can see that tracking, right? And we can hone in on what's working and what's not, and that message, and look at those individual channels to say, okay, how can we scale up and raise more capital here? Hiten, was that part of your sort of mental math in deciding to raise capital this way? And when you have in the past, like, what have you seen work for you guys as a brand?
Yeah, so we covered a lot of interesting points, and I wanted to piggyback on some of the things that Rich and Buck have talked about, which is that now our cap table is a very hybrid cap table. We've got institutional investors like the Engine, we've got family offices, we've got strategics like Gates Corporation, and now we have, retail investors. It's through WeFunder. We have one line on the cap table, but we have a lot of retail investors, and we can now continue this multi-pronged strategy forward on any platform, including Dealmaker, which is exciting. And we can continue to raise capital from family offices, from strategics, and from institutionals. So that multi-pronged strategy holds true even if one decides to do crowdfunding, which is fantastic. And then in terms of marketing efforts and brand building, which Buck mentioned is so important. When I joined, I had to find a way to do it quickly, right? How do I get a lot of people on the platform? And so initially, I thought that I should probably start with a platform where I can find investors. And so we looked at, who already has an investor base that I can start with. And so we looked at WeFunder, we looked at Republic, we looked at Start Engine. And I think at the point that we were, it made sense for us to start there, to start with a base. But now that we've started to build a brand and the brand is built, I think we can open up and reach a wider base if we are to start to drive our own fundraise ourselves using the Dealmaker platform. One of the things I did to get the brand building started, since this is one of the questions that came up, is I asked the team, is there anything that we're doing that is remarkable beyond the core tech, which is of course very interesting? And the team mentioned to me that Rise Robotics had built the world's strongest robotic arm. And I said, get out of here. That doesn't sound right. They said, no, this thing that we built for the Department of Defense, it's a material handling unit, lifts 7,000 pounds. It is the world's strongest robotic arm. The next strongest one is built by Fanuc. Now, Fanuc is a $6 billion company. They have an arm that lifts 4,000 pounds. We have one that builds 7,000. And I said, well, what makes it a robotic arm? And they said, well, it's got 6 degrees of freedom. It can manipulate things in all dimensions. I'm like, I don't believe this. And so the team convinced me that we actually had built in this facility the world's strongest robotic arm. So we called the Guinness book and we said, hey, we want to get into the Guinness World Record for this. So they came, they asked us, they did an industry search. We had a third party come in. They wanted officers from Somerville to come and observe the test. And we did a test and we got into the Guinness book. And so we used that to sort of launch and announce. I did a press release, did a celebration here, invited people of the local members of the community, invited the press, and that got the thing sort of started. And I think that many companies inside, if the team has been together for a while, have done something unique and exciting for the first time. And if they just were to look around and ask the team like what's going on, they'd be surprised at what they could find and how they could celebrate what they've accomplished. So that's one of the tricks that we use to sort of get out there.
Wonderful. Well, there's such a strong digital component to that, right? That you mentioned both the sort of, noteworthy headline there of, strongest robotic arm, right? And then capitalizing on that to, bring in eyeballs and launch a raise on the back of that. That's really like, how do you take what you all have built and match it to a digital investor acquisition game? Rich, if there's anything there that you want to touch on, I've always loved the visual nature of Flippy, right? Or anything in particular that you love to look at in the dashboards when you look at things driving marketing ROI. Are there any tactics or strategies that you want to share with the audience?
Well, Flippy does make for a good video, that's for sure. And I think there's an element that drives of that, quite frankly, that drives Miso's past success in crowdfunding is that it's simple to understand. Everybody likes robots and they're intrigued by them. Everybody knows restaurants, and the collision of those two things is pretty simple to understand when you've got a robot arm making French fries. And so I think that surely helps, right? So I think I see crowdfunding companies go out and try to raise, and I can't even figure out what they do. And obviously that's not going to be successful. So there's a marketing narrative like Hiten talked about, and I love the, kind of proof point that the Guinness Book of World Records provides you just in terms of a hook. And I think that's, part of the battle. But I think there's another element too, which is just the transparency narrative. The way you come to investors and talk to them about your company at this stage, ultimately, I think influences your success at the later stage when you're trying to create a liquidity event for them. Like for me, I came here, I took a massive pay cut. My pay package is largely built on success. And so for me, I'm in the same boat as the shareholders. And so we are very aligned on our agenda about creating, a liquidity event, an exit for Miso. Well, one of the things that attracted to me about this job is the idea of taking Miso public. And so because I think it's a simple story to understand, there haven't been that many companies that have raised equity crowdfunding at scale that have gone public. And so I want to be one of the guys that does that. I have a crazy thing in my world where I always like to be the first person to do stuff. It sometimes makes for very long days, but I'm motivated by that. It gets me up every morning, and I want to be one of the guys that does that. And so when we go and we hopefully try to take Miso public, being able to explain to Wall Street that there's 40,000 retail investors who have already raised their hand and said, I'm interested in this company, I think is a really great proof point. And so if you're transparent about the way you tell your story to them early on and you communicate with them, after you take their money, and you're consistent about it and you're transparent about it and you don't just forget about them, by the time you're ready to go public, which is what we're all focused on doing, I think that's a real valuable asset. Similarly, like we've talked about earlier, if you've got other types of investors on your cap table, they too bring different types of value. Like a strategic is an obvious acquirer of the business who may say before you have the opportunity to go public, hey, I'm just going to snatch that up. They are motivated to support your success so you can get big enough that a large company who's a strategic could make that strategic acquisition, before you even get to the public market. So I think a lot of it just comes down to, how you talk to people. And in terms of the cost of capital, that's a huge, huge consideration. I think that, I'm very data driven. We make a lot of decisions here, based on data, and cost of capital is a massive one for us. We look at it all the time, and we want to make sure that we're being as efficient as we can through our paid social marketing, through our email campaigns, through our webinars. Like we really pay attention to the cost of all of that, because it has to be. It's better for investors to have more money go into the pocket of the company that they can use for operations, as opposed to having to spend a lot of money to drive every dollar. And I think that's really important to pay attention to as well, beyond just the marketing narrative and the transparency narrative and all the things that really, I think, lead to a successful crowdfunding campaign.
Yeah, Rich, I'm glad you brought that up. I wanted to, that point there ties back to what Buck had mentioned before about that programmatic nature, right? You can see where the spend is going and monitor your cost of capital, right? So that, you make sure that you all have what you need to execute. You touched a little bit on community there, and you guys are making my job as moderator easy. Wanted to talk about some of those community benefits. Buck, anything to add before I move on to community? Because I also want to talk to you about community, having done a lot of capital raises in this space across different brands. You're certainly one to speak on that, but anything to touch on in terms of tactics or strategies before I move on?
No, just I think don't take the crowd for granted. They're real investors. They are valuation sensitive. You can't just raise money from them and then forget about them and then come back to them later and expect them to still be there. You got to have a constant drumbeat of communication. It's I think that you probably need to communicate a little bit more than you do with institutional investors. Because institutional investors, there's only a handful of them, and they're going to call you on the phone. So thankfully, there's not 40,000 people with Rich's number. You never get any work done. But you have to be really thoughtful about communication.
Yeah, I think
the community feel part of it.
Yeah,
I think there's another part of that too, which is in some respects, one of the great things about crowdfunding is that you are forced to talk about your business, whether you like it or not, because when you take crowdfunding capital, you then are entering what is a fairly highly regulated industry by the SEC, and you're then required to file, future reports a couple times a year that talk about your business and that, show your revenues, show your expenses, but they give you the opportunity to talk about your business in a way that, and you surely don't want to be filing, bad reports with the SEC. They don't tend to like that. And so I think there's an element of it that's forced. And then the part that Buck's talking about is to go that extra mile and to then, really provide a whole lot more color to your investors through that recurring drumbeat. And to me, what we try to do is we try to provide that communication in different ways so that people that are looking for different communicative experiences can get what they want. We try to meet people where they are, not force them to come to us. So if you're into, every financial detail of the business, you can go to the SEC's Edgar website and you can see that about MISO. And then, similarly, if you like long, lengthy narrative shareholder updates, we send those. And if you want bite-size, kind of small blasts on a more regular basis, we send those. And if you want social updates, we post those. We even leverage, John, your Engage platform that Dealmaker has on their platform to post updates. So we try to provide these updates in different formats so that people that want kind of the short burst of information can get it. People that want the deep dive can get it. I think it's really important to kind of take advantage of all of those. Otherwise, you're missing the opportunity to share your story with your investors.
100%. I'm glad you guys are touching on that. And Buck mentioned it, don't take that investor for granted, right? And that's the power of that communication. And honestly, it's that communication, A, it's good for transparency, but also B, leads to more capital the next time that round is open. So, Rich, I know you guys have had success with that, and it comes with the transparency of communication. And then Buck, companies under Vibu have done that as well, right? So that communication that you do, right, is about transparency. But next time you're going to raise capital, it's helpful that you've spoken to them before and given them ongoing updates. So every time you reach out, it's not just to ask for money. Basically, that communication strategy is really important, and want everybody to note some of the things that Rich talked about there for those different mediums of how that takes place, right? It's really important. You may send out a SMS message before a webinar to remind them to hop on it, right? Or, do that long form email, or like Rich said, direct them to the Engage platform where they can, access information about their investment.
Yeah, and I think webinars are really important too.
Yes.
You mentioned that. And to me, that's the equivalent of a public company's earnings call. They do it about once a quarter. We do webinars about once a quarter. And so Anybody can jump on, whether you're a potential investor, a current investor. Our competitors, we know, jump on those calls. So we try to be thoughtful about what we reveal about things like our sales pipeline and so forth. But to me, that's great. The fact that they're tuning in, I think, is really important. And so that's just another path that you have to make yourself available for that type of communication.
Yeah, spot on. And then for you all, right, like a lot of interest in campaign number one for that raise, right? You built up a community. How do you think about talking to them in between rounds or any sort of strategic approach there?
Yeah, so we're doing the same. We have a monthly update that, frankly, called the Rise Insider, which has been going out for a long time, even before we started our round in January. And then we're doing the social posts. So, when we have events and we have people coming into the office, whether it's an open house or we did a little stunt here where, because we knew we could, we picked up a Ford F-150 Lightning using the strongest robotic arm and kind of spun it around. And we had a lot of people here for Father's Day. Kids showed up just to see it. So it was nice to do it for the community. But things like that, we end up posting that on social media so people can see what we're able to do, what we are doing. And when we go to conferences and events, we talk about them. And then we usually do a quick social post of, here are how many contacts we made, and here's how it's turning into our pipeline. Here's the progress that we're making. And we happen to be, as I mentioned, in this really exciting phase of commercialization where things are getting productized. What you see back there is a test fixture that we're setting up to start testing the Liftgate platform. So we have a lot of visual things to show our investors in terms of progress, so they can see the progress is real. And we usually put something out 2 to 3 times a week on social media where they know exactly where the company is and the progress that we're making.
Wonderful. Yeah, that was really well put. I think you had touched on something there that I think, I don't know, for whatever reason, founders and teams and leaders kind of get hung up on, what should this update be? How do we update them? And I always joke, everything's grist for the mill. It's, you're at a conference, so you talk about it, right? You've got something going on the floor back there. It's like you talk about it. I think people overlook the content that they create. That's just a byproduct of their business anyways, and their operations, and how that can be used for really compelling content, engaging content, right? And keeping people informed. So it doesn't have to be anything net new that you create. Oftentimes it's just a byproduct of your business. People are curious what's going on.
Yeah, I sometimes have to remind my team, hey, we're there. Can you please take a few pictures and some videos, because you are already there. And most recently, I've started to egg the testing team saying, hey, we're doing all of these tests. Let our investors see what we're doing to make a robust product. Let's get it out there. So, but you're right. It's all happening anyway. All we have to do is just take a camera up to it, right?
100%. So I want to save time on the back end here for everybody with some Q&A. Before we get to that, I want to offer a quick lightning round that we'll do here. You guys have dished out a lot of advice, right? How do people raise capital? How do you think about that? Nurturing, data-driven capital raising, the capital stack. Is there anything else that you want to touch on, or maybe one sentence of advice for, founders out there and operators who are thinking about raising money from their community, or, leveraging digital to build their own community? Let's start with Buck on that one, and then we'll go Rich and Hitan.
Sure. Well, if you're foolish enough to be a robotics founder, you've entered the most capital intensive sport in startup. And my advice to you is control your burn. Don't go crazy, and don't spend money you don't have. Because especially when it comes to crowdfunding, you raise the bulk of your capital last month, last week, last day. You don't know how much money you have until it's all over. And so don't spend ahead of that. So I think that my advice to you is just control your costs, and slow it down if you need to, because the only reason you'll ever fail is you run out of money.
Well put.
Yeah, I agree. Robotics, and we've started referring to robotics as physical AI. It's kind of where AI meets the physical world, and it is as Buck mentioned, it is a rare vertical, I guess, in the startup community, because it operates differently than most other startups. If you're a fintech business, you're going to kind of grow 5%, 10%, 15% every year. It's going to be a nice steady climb and you can see progress. And that's what institutional investors like to see. Robotics, on the other hand, you're coming in, you're being disruptive to an entire industry. And so you're going to kind of starve for a while because you have to drop a lot of capital into the R&D and the development of your product. And then you've got to go out and you've got to prove the product market fit, and you've got to find some customers to help you get to, kind of through the testing, and you're going to have to learn from them. There's like a whole bunch of stages to it. And all robotics companies go through the same exact phases. I mean, if you think about Waymo even, everybody's been talking about Waymo and their self-driving cars for 3 or 4 years. They've been around for almost 20 years, where they've really taken the time to be very thoughtful about what they are designing, because obviously the stakes are very high. You've got life and death situations, but now those cars drive better than humans. The accident rate on those cars is minuscule compared to having a human behind the wheel. And so robotics is just very unique, and it's not all institutional investors really understand that, and are in it for the long haul. They're out to get sometimes a short-term return. And so I agree with Buck that we're a little bit unique. I also agree with Buck that you're better to start sooner than later. I think the thing that I see that creates failure for companies is when they start at the very last second, thinking that equity crowdfunding is going to just be this like savior, that they're going to flick a switch and the coffers are going to fill up tomorrow. And that's not how it works. Like, you've got to work it. You've got to be patient. You've got to be thoughtful, and you're going to probably raise most of your capital at the end. And so this is really a game of survival. And the companies that don't make it because they just can't survive, right? So don't wait too long. Think a lot in advance. Start to learn about it. There's different types of crowdfunding. There's a Reg CF, which is kind of a smaller round. There's a Reg A, which is a larger round. Educate yourself about the difference between those two, because they're good for certain types of situations, and you really need to understand which of the two that you want to do. And so I think you can't ever start learning about how to do it too soon, and you can't start that process too soon.
Well put.
Sorry, I know we're lightning round with this, but Richard's bringing up a good point. You're touching on that you don't see a lot of progress in robotics companies, and I think in a way, because like to build a piece of hardware, especially when it's in the food space, you've got to design it, you got to make it food safe. Whoops, you got to build a whole new one. You probably got to build 3-4 products before you can actually get into revenue. And if product cycles are like 12, 18 months of development, geez, that's painful. Why are robotics companies failing in the institutional world? It's because seed investor invests on the dream. Series A guy sees progress, maybe some LOIs, and by the time the Series B comes, there's not a bunch of revenue sitting there to validate. And so boom, down round, or the company dies or does an extension round. I see so many companies that are in the hardware space that just can't get there. They get to like the 5-yard line. There's a couple companies I could name, but I guess I shouldn't here. They get to like the 5-yard line, and they're just dead because their investors are worn out, and they're not waiting for that big promised land that comes when you finally have a product that you can ship. Miso's got a product you can ship now, and it's like, and that's why these robotics companies are dying in the institutional space. That's why I think it's important to kind of mix in different kinds of fundraising.
But I think the payoff is really big if you can get there, right? Obviously, you got to get there, but if you can get there, then the disruption that occurs in the payoff is a hockey stick. Unlike that fintech business that I said earlier, that is a nice slow build. You starve, and then boom, 1 year you go like that, and that's the real kind of payoff. And I think that's what we're all looking for. That's why we're all doing it.
And the lock-in's nuts. I mean, like you like, especially in the food space, like you jam, like let's say Flippy in the back of a kitchen, you install it and bolt it into their store, and it takes them forever to get that brand to be comfortable with a robot in the kitchen, which is totally alien. Like there's no way that like some competitor is going to come along and like boot you out of that spot. It's just not going to happen. And so like it's worth the payoff, because once you get in there, like you're in for life. I'm not saying you're in for life, but like you're in for a very long time. It's super hard to get you out, and like that's why acquirers will buy you, and that's why you can go public successfully.
it is a land and expand strategy, I think, in most robotics, and especially when I think about the restaurant space, it is not a technology business. I mean, the front of the house automated about 20 years ago with the advent of OpenTable, point of sale systems, online reservations. The former president of OpenTable sits on our board. He talks about that moment a lot when the front of the house was modernizing. The back of the house has operated the same way for the last 50 years. So these brands are not tech forward companies. And so, as Buck mentioned, if you can get in there and then you're bolted into the floor, and there's a lot of inertia, like resistance to change, right? Then when it comes time for them to automate the next thing in the kitchen, they're not going to go elsewhere. They're going to come to you and say, hey, let's do this second product. This would be really great. And I've got this real problem. I want you to help me solve it, right? So it's the land and expand strategy that is so unique in robotics that really allows these companies, while they might get kind of a slow start, they have a lot of longevity for the ones that are successful because of that. Because what they do is complicated. It's not something that the restaurants can do on their own. They need a partner to do it, and it takes a while to build that trust with them.
Yeah, certainly.
The restaurant space is cheese in the crust.
Well, Rich, and it ties back to your point, right? That's like the wonderful nature of bringing the crowd along for the ride, right? People didn't have access to those opportunities before. So, Hiten, anything from you in the lightning round here? It turned into a storm, which I love. Thank you. Easy as a moderator.
Yeah, I agree with Buck that you want to conserve cash, obviously. Also, the fact that these products are sticky, right? So it's not like software, which again, as Rich said, can be booted out of there. Once we get a design win on a particular machine, I mean, we have that design for 10 years, right? So it's recurring revenue for us. We acquire the customer once, and then as Rich mentioned, it is land and expand. So we get a design win with one machine with one OEM. That OEM is going to electrify their entire line using our tech. So very much land and expand. The one other thing I'll say is that not to just look at the retail investors as a source of money. So our investor base right now is not as big as the other two gentlemen here in the call, but we've got 1,100 investors and growing. And so many of them are reaching out to us and telling, hey, how can I help you guys? I can make other connections to other investors. I can make connections to OEMs that would be interested in your tech. I can get you into this trade show. I want you to go talk to this angel group, right? So we have this huge pull from our investor community that's really turned into our champions, our evangelists, our salesmen. I have the largest sales force of any tech company in Massachusetts. I've got 1,100 salespeople. It's just, and it's growing. It's just fantastic.
Spot on. Yeah, Rich has people in Montana there. Yeah, thank you guys for that. We've got a couple minutes here. We'll get to a couple questions. I'm going to take a few that I felt like had bubbled up. If you guys have anything to piggyback on these, please do. I've got one that I'm going to direct at some of you guys here, but one of the first questions was around the crowdfunding raise and your average, cost per investor. They talk about marketing efficiency ratio, which is as you scale up. Maybe let's just talk about return on ad spend. So in aggregate, what these campaigns can look like, and then the budget breakdown there. So, we see some campaigns 3x, 6x. You can have extreme outcomes in there at 10x, right? Let's just say that, we're at 5x on a $5 million round. So you've spent $500K to raise 5 million, right? It's pretty unevenly weighted, right? As Rich, we've ridden with you through some of these closes, and Buck, we're planning to scale up in that final month to bring in that capital. So, that can be how it breaks down. The return on ad spend there is going to be dependent on how well you can tell your story across these different channels, do these nurturing tactics like Rich had mentioned, those webinars, right? So, ROAS is always going to be a function of that and how well your story resonates in those. When we think about the next part of this question is the allocation breakdown, right? Where do we spend that across, paid media, social, email, that sort of thing? Some of those channels are a little more last click, we call them. Email, they come in, they're familiar, right? And then you're continuing to educate them. They may, come in and invest, after they get the webinar email that goes out. When we think about channel allocation, it ties to something Buck had mentioned, and Rich had touched on it too, that sort of programmatic nature. We can see which channels are moving the needle, and not just which channel, which ad, right? So we could say to hitting like, oh, that Guinness Book hook is really working here. We're going to use that video, or, you guys lifting up the Ford F-150 Lightning. So some of that budget allocation is something that we determine as we continue to scale up the campaigns. And that's why it's more heavily weighted at the back end, right? We're going to spend more in that final month behind the urgency of, final month to invest, final day to invest. And then also, what images, videos, headlines work best to tell your story and bring investors through the funnel. So there's a lot that goes into that. And again, it, like Buck had mentioned, that programmatic exercise of, how do you spend that capital? And like Rich had mentioned, how do you do that in a way that's, make sure you're keeping to your efficiency standards? Long answer there.
Well, I'll tell you how we do it at Miso.
Please, Rich.
Obviously there's different costs that go into it. Advertising is only one part of it. So when you think about ad spend, that's in addition to things like legal and PR and other types of marketing and stuff that goes into that. So for us, we try to get a 3x return on ad spend on everything we do. If you think about it, that's roughly a 30% cost of capital, right? And then we try to bring that down into more of the 15% range by supplementing it with things like email marketing, which really doesn't cost you that much, PR, which doesn't really cost you that much, webinars, and bring that down, right? And so that to me is a really thoughtful way to do it. And as you mentioned, John, like you have to be data-driven in how you do that. We have brought down the cost of our crowdfunding capital considerably since I've been here. I think some of that is just because of my background. At VIX, we, built a team of many people, and all they do all day long is paid user acquisition on social media. And so I think I came into this with probably more experience and expertise around, driving return on ad spend than probably most people have. But I think it's caused us to really be very considerate of our spend and very considerate of using data to tell us where to drive that spend. And so, as you point out, John, like every day we look at different ad sets that are out there running across Instagram and Facebook and all kinds of other different platforms, and we turn off the ones that are not working. And it's not a set it and forget it business. You're looking at it every single day. It's very time consuming, and we've gotten, I think, very consistent about how we do that so that we're not wasting money. And sometimes it's things that you don't quite understand. It's to steal Hitan's line of, or his concept of lifting that Ford F-150 truck. Like if it's a blue truck, it may outperform a red truck. And you never really know until you just go out and start testing those ads. So for us, it's about getting the story out with the right consistency so that you're telling a consistent story across platforms, and then doing it in a way that is, doesn't break the bank, because it's very easy to let the cost get out of control if you're not paying attention.
100%. And that's that data-driven aspect. It's about community building, how you nurture them. We usually get to a couple more questions, but you guys really kept it going in those sessions, offering a lot of insight and detail there. That's going to help everybody on here, think about how they can raise capital this way. So I want to wrap up here, say, thanks to everybody who attended. If we didn't get to your question, we answer these in follow-up meetings. We're also going to send out recording, and a big thanks to you three guys. Thank you so much for joining, shared a lot of insight on there, and also kindly made my work as moderator easier by keeping the conversation going. So I really appreciate that. For the panelists here, if you guys want to just hang on while we end the live, you can dip after that, but we just got to upload the recording here, the audio, so that people can hear this afterwards. There's a lot of people who joined, but we're going to get more as we send out the recording to everybody. So big thanks to everybody who joined, and as well as our panelists here. Thank you guys.